Hi everyone, this is the 28th of March 2020. We have a few days left for the month end and quarter end in terms of chart readings that we will see. So that makes for an interesting set of readings. It's of course the year end for everybody on the financial side. But this has been a very, a week full of news events because you've had news flowing in from everywhere. That is central banks around the world taking action, and it becomes important to understand what that means for the market. So I'm going to focus on what it means, and I'm going to be talking quite a bit about the dollar because I think that's the central factor that moves when such events really take place. So that's what it's going to be about. Of course, we'll come to the Nifty also. But starting with this, what we're really looking for is where the heck the dollar is headed, because that I think is what has created the near-term crisis. In fact, from December, I should say October itself, the Fed has been intervening in the repo market, which is providing dollars through various measures, though it was not calling it QE at that point of time. But those measures were intended to really keep the dollar market afloat, keep it liquid and not create a crisis. But now the coronavirus event itself has made that the pressure point of everything. So we've seen a lot of volatility in the dollar. So this is a chart that if you have seen my gold video which I'd done with Sher Khan, and it's there on YouTube. I've shared it a couple of times. If you've seen this chart, you know that you're looking at cycles, but you also know that whenever anybody asks me on Twitter about time, I always say that time-based sciences have a high failure rate. Still at that point of time, I made this chart out because it was showing some consistent up and down movements for the dollar index over several years. Now, there's also the alternate view that this entire period, which is a declining period for the dollar, was ending and you were going to break out on the upside into a bullish phase. So that's what seems to have happened at the back end here. And then the question was, will this 7-year cycle work, or will this breakout really work? And I think that question continues to float both ways based on both the actions that you see from central banks and based on actually what the charts are doing. So what the charts did is, from this peak, I was right to think that the dollar would peak and head down. So it actually happened. We sold off, and this sell-off here looks like a 5-wave decline, which is why it looked like impulsive and probably the start of a longer-term move. But at the same time, what was followed is, after that initial move, we had this retracement, and it's continued to gyrate, I think, for an entire year here near the breakout point, and has not been going anywhere. In fact, some of the recent moves, as I switch from a quarterly chart to a daily chart, have been very, very volatile. And these moves are volatile because we are actually attempting to break out of this range on one side or the other. So initially, my bearish view on the dollar did start to play out from this top in September. So we were looking at that as the as a reflation trade. In fact, this is where I actually was bullish on markets based on the dollar trend. I thought this would fall and drive up asset prices, which is what happened. You saw metal prices and even equities do pretty well. But suddenly, as this crisis came to a head, I think from January, the dollar started to head higher. Initially, it looked like a retracement, then it became a spike. And then that's when the market started to look towards central bank action. So this big gyration you have seen is initially expectations that when the US market started to sell off, that there would be action. And that action did come in the form of 2 subsequent rate cuts, almost bringing the rate back to near zero. And then it got followed by everyone else, which is Europe and various other countries, UK, Australia. Everybody's cutting rates. Asia also, many currencies have started to fall on that basis. And so rate cuts happened everywhere as all central banks felt the need to intervene. So, when the previous dollar rally happened, and I have to really go back to this phase, this is when you had the first dollar rally. At this point of time, the dollar rally was driven by various central banks, taking action, but at different points of time. So QE was already in force. QE3 had already been announced prior to that, so it had kept the dollar from going up. Eventually, at the end of this, the US was just simply going on with its policy, not doing anything new, and everyone else started to weaken their currencies. So Europe started with whatever it takes policy. Japan had Abenomics, which we always call it that, but essentially was a policy to weaken its own currency and send the yen to maybe 120, 130. Some people are predicting 180 eventually. It's not gone that far. It eventually stopped in between for a long consolidation phase, but that period itself caused the dollar to run up a bit. And this run up in the dollar had all the side effects that it usually does, which is hitting commodity prices, commodity producing emerging markets like Brazil, Russia. All of them had their crisis in this phase. Interest rates of most of those countries went into double digits. And then eventually later, as the dollar cooled off, those pressures cooled off, and we've seen some kind of a reflation rally in this phase in commodity prices. Initially with gold going up, because gold bottomed around here, before this final peak, which is when it formed the ending diagonal, and I had started making these videos and I posted this dollar chart for the first time. And after that, most commodity prices picked up, and then you had this rebound. And since this rebound, we've been waiting to see, okay, if this is a 5-wave decline, will you get another leg down? But there's also there's an alternate scenario to look at this 5-wave. If it's not the beginning of a downward trend, it's an expanded flat A, B, C, and maybe you have a larger upward trend, and that's what you're trying to figure out. Problem is there are too many gyrations. Now just look at this. We've tried to break out on the upside, and the moment it started to become a risk issue for everyone, the Fed again stepped in with trillions. I mean, now this time, now the numbers, earlier when the 2008 crisis was there, and the first time we got $700 billion bailout packages, it came as a shock. Now I think when we hear trillions, it doesn't even come as a shock, because we are almost numb to now these numbers. They are beyond what we can even put in our head and understand what they mean. So that's where they've reached. And so when you get that, what ended up happening this week is the dollar's again gone back into this range. So when you actually look at the monthly candle, it's going to be one crazy candle. So if I simply change this to a candle chart, okay, and then I move to the month, you see what we actually call a high wave candle. A high wave candle is, there are different names for this. Some will call it a dragonfly doji. Let the month really end. If you have a very small real body, and then you have this big spike up, big spike down. We have not seen anything like this in the dollar ever before, and which is why I call it a dollar crisis. So I had a chart which was about the dollar, which I used to call the dollar crisis chart. So I'm going to go to that now, and I stopped writing about it after a point of time when the whole trade shifted from the up dollar to the down dollar, and but I've keep my older chart saved, and some of you who've been long-term subscribers would have seen it either in my previous videos. And I'll relate to why I thought of it this way. So I'm going to show the 90s when the first time you had a dollar run. Okay, so from a downward trend, the dollar all the way into 95, you had the dollar turn around and start going up. And so it went up in two waves. I've circled this pink area where there was a consolidation, and then there was a second wave. So what happened in the first wave of the dollar? This was into 97, 98, which is exactly when you got the Southeast Asian crisis. So when the dollar started to rise, it always creates a problem for weaker hands at that point of time. And that time the weak hands were probably the Southeast Asian, tigers, as they called them then, because they were become exporting economies and were bringing in a lot of dollars, and a lot of speculative money went into those markets betting on the upside. And when the dollar rallied, they all started to rush out, and it created a financial crisis for the Southeast Asian nations. And so that brought prices down there significantly. But when this consolidation happened, a lot of measures were taken to keep that crisis from going, with the IMF stepping in, and most of the Southeast Asian markets bottomed out. Eventually, what happened after that is you had the tech bubble. So equities around the world, including India, US, started to do well on the back of the tech sector. And then late in 99, 2000, you had the second breakout of the dollar out of this range, which is exactly when the tech sector popped, and that bubble went over, and all the tech stocks declined 60, 70, 90%. And so this is what I call the second dollar wave. So this second dollar wave was associated with the popping of the tech bubble around just at the end of 1999, and the tech bubble popped at the first quarter of 2000. And gold sold off then, but didn't make a new low versus what it had made in 99 already. So that's another interesting fact that happened. But US indices, of course, peaked. This, of course, the Dow, the Nasdaq was the one that fell the most. So it doesn't look very sharp down on the Dow during the second dollar wave. But the second dollar wave only pushed Asian markets into a wave 2 correction, because most of them had already bottomed after the Southeast Asian crisis. But the rally that they had after that on the tech bubble, they just retraced a large part of it. But the US went through a big drawdown. So that's what happened. Point is, you had two dollar waves, the first, a pause, and then a second. And so when I made this chart, I was expecting something similar. I thought maybe the first dollar wave was, maybe it was this, and this is the consolidation. So was this the second dollar wave? It created a lot of issues around the world. But what we've seen now is this itself is a long consolidation phase in the dollar. Whether I say only this is a consolidation or take this entire range, because we've not made a new high since 2016-17. Jan of 2017 is when the dollar index peaked at 103.8, and now we have come very, very close to going past that. The futures data probably has spiked a little bit, but I think spot prices are still at least a point below that. They came close to 102 but didn't go above 103, and so that's where we are, very close to starting what could end up being a second dollar wave. You can see this lower trend line, it didn't break despite all these attempts to crush the dollar. And there's one more attempt going on right now, and what I'm watching out for over the next couple of days is whether this will play out, whether whatever the US has done in terms of a $6 trillion package combining the Fed and fiscal policy, will it be sufficient to break the dollar on the way down, to break this trend line and send it back into a dollar bear market, which would then become very bullish for gold, or is the dollar going to really turn around and head up higher? Now I'm going to throw some light on what is happening and how this time has some difference from what we saw the previous time. See, we've now just covered the similarities. What is different is that the second dollar wave of 99-2000 was a natural wave where the dollar went higher, probably on the back of a falling euro. The euro was not yet there. Euro only got introduced around that time, so it had just started trading, and so maybe that was the initial impact, and you didn't have the rest of the world doing that. Now the situation that you face and why these gyrations in the dollar are happening. See, while all these gyrations are happening, if you just remove the DXY and look at non-DXY currency pairs, and I've actually written about the emerging market currencies index a couple of times. So this is the chart I've posted a few times on Indiacharts, and just zooming it in a bit. What I'm showing here is that this is an ABC decline. Okay, so this was the first wave of the dollar in 2017 when it was 2019 when it was rising. So note, this is when the currencies were really doing well and most markets were booming, which is 2017 when the dollar was falling. Moment it stopped falling and rallied back, you had this big impulsive move down in most of the Asian currencies and emerging market currencies, and so that's the time you saw a crisis again re-emerge in many places, especially in Asia. Though Brazil and Russia are actually doing much better because of this previous advance, and they were still having the rub-off effect of higher oil prices and higher copper prices and commodity prices. But the first impact of this was most of Asia. You see that in charts of Thailand, Korea. Most of these places came under pressure, and actually, even though the dollar started to weaken and these currencies strengthened from point A to point B, many of these markets didn't really make new highs, or very mildly so. But if you draw a trend line of the highs, they didn't go past that, and that's also true for India, because 12,400 is where the trend line of the 2017-18 highs was, and we didn't really surpass that in this year. So what is happening now is we've broken the lower end of this channel or flag-like pattern, which I've marked as B, and we've started wave C down. And so this is a completely fresh new decline in the emerging market currency pack, and it's clearly not over. It's got many more legs to do. It will be almost equal to wave C, or it could even be extended, so we don't know. But the important part to know is this is not over, and this is having nothing to do with what the dollar index is doing right now. And there's a very important reason for this, that unlike 2017 when each of the countries like Europe, Japan and all were weakening their currencies, the US was not doing so. So they were taking rounds, each one was doing it at a different point of time, and there were gaps, and so the impact was on one market at a time, and therefore the overall impact on the dollar was not uniform. Now what you're seeing this time around is almost like a currency war, where everyone is devaluing at the same time. So you had, within I think the last 2 weeks, you've had almost everyone devalue. I think, in fact, most of you would have felt India is the only one not cutting interest rates and not doing anything. And finally, this week, in fact, yesterday, the RBI has given in, and it's done a lot, not just a bit. I think earlier it was simply buying bonds. So it had done some amount of, stuff on that side. And once it had started doing that, if you didn't notice, exactly a week ago, and I'll come to the USD INR chart, the premiums on the currency actually shot up. So yesterday's measures, I think, from cutting CRR rates by 100 basis points, the RBI has cut its repo rates by 0.75, and so that's a huge injection, and still announced an additional liquidity of various bonds, extending to HTM category a lot of the SLR limits and so on. So if we just add it all up, and they've added it up and given us a number of 3,74,000 crores of new liquidity. So that's directly weakening your currency. You don't see it like that. Yesterday, of course, the currency was stronger at the early part of the day, probably because it was also rollover day. And there's a huge open position in the USD INR. highest on record. I would say around 42 lakh contracts had to roll over from March to April. So that may be the reason you saw a big knee-jerk reaction in the currency pair early in the morning, and then the March contract closed by noon, and the second half you actually saw a bounce back. And if any of you track the NDF markets, which is a big measure that the RBI took, they actually said that they are going to allow banks from June into the NDF market. I was wondering whether it would be right away. They've actually waited and given them time. I wonder why, because what's the big deal about allowing them now and allowing them from June? Probably they want to wait for the crisis to pass, but it's a good time for banks to really use the facilities around the world for better pricing of the currency, because the RBI is consistently intervening in a market where I think the rupee relative to most other world markets would be the most overvalued. So I've actually used, so I think I shared a chart yesterday on social media, and I'm going to go to that as well. But the point being that the NDF market will be opening up to banks, and in that market, moment our market closed, I think a couple of hours later, if you went into the night, the USD INR was 60 paise higher. Okay, so it was at 75.85 I think, or 58, and when it closed, the spot was around 74.80. So almost a 60-70 paisa higher reading on the forward market outside of India. And so that's what's been happening. The rates outside actually sometimes very differ. Sometimes it's down also at times against what is happening here. And these things need to align. We need to really reflect. But broadly speaking, every central bank is weakening their currency. This is a kind of a currency war indirectly. And that's why what you're seeing here is very different from what you're seeing on the DXY. See, in the DXY, the dollar index is just US and the developed market. So US does something, Europe and Britain do something, or Japan does something, and they counteract each other. So while they're even weakening their currencies, the currency pairs remain stable. However, when it comes to the emerging markets, their currencies are all pegged against the dollar. So we are not really looking at cross rates as to how they're doing versus the euro and so on. Though those rates do exist, but the dollar becomes central, and so they all end up weakening themselves against the dollar. So that is what you're seeing, is that most currencies are weakening against the dollar, and the dollar itself is trying to weaken itself against, if not everyone else, at least the other developed markets. So far that attempt has failed twice. This is the third time they've done it, this time by going completely overboard into trillions of dollars. And I still want to see whether that plays out in full scope, or at some point of time the dollar catches a bid again. Because in terms of emerging pairs, like I said, even in USD INR was up, USD BRL was up yesterday. Many of the other pairs didn't really go down with the dollar index. They are all, so whether it's the Brazilian real, probably the AUD reacted a lot more, but they are all back to their 20-day moving averages where some of the currencies are concerned, like the Australian dollar, the Singapore dollar, or the Canadian dollar. So they are all back to supports, and I think next week the main thing I'm going to watch is again whether those pairs take support. So rather than simply look at the DXY standalone, because this is more about what all currencies are doing against the dollar and not just what the dollar index itself is doing. So here's the chart I was talking about. I call this the relative rupee. I've published it many times on Indiacharts before, and I used to publish it with my economic theories more to identify points where inflation used to shoot up. So every time this indicator would reach the top end of the range, I could actually say that you're going to see some level of inflation because you'd weakened the currency too much, and it actually happened both in 2010 and 2000 at this point of time. See here, 2010 and again 2013, and you had these jumps in inflation, and eventually RBI had to raise rates. Now, partly it's also because, well, the currency had weakened and they were using rates to stabilize it. But it's also showed up in inflation numbers. But what you're seeing now is, after going to the bottom end of the range, which it has done before and always come back, it has remained at the bottom end of the range for a prolonged period of time. Down here, it attempted to go up, then again down here, and it's just staying down here for a very long period of time. In that sense, I would think that we are relatively overvalued compared to other currencies or the dollar index itself. We have not really moved down so much against the dollar as many other currencies are doing or have already done, because they all down 30-40%, whereas we are barely off 10% from the highs in terms of the INR. So that's the situation, and I feel at some point of time you're going to get a big spike, and the currency pair itself probably already, the currency traders are already seeing that, which is why just a week back the premium went from 40 paise all the way to a rupee. So suddenly you added 60 paise more to the April premium on the futures market. So my larger outlook for the USD INR remains that we are in a fifth wave. The fourth wave ended in 2018, and from there we had our first impulsive rally, which I've marked as wave 1 of 5 and 2 of 5. I would have liked the third wave to take off. So in 2019, I was expecting this itself to be the larger third wave, but it again subdivided into another 1 and 2, which took several months. And now we are finally into the third wave. So this is what is happening. We actually started wave 3 of 5 on a big scale. And probably not over. It does look like this is a 5-wave rise right now, but on the daily chart, if I go to my daily counts here, now you'll see a lot of noise because I put a lot of indicators on my daily count charts. But simply looking at this, what you see is the subdivisions show a 5-wave developing. It's 1 2 1 2 3 4 3 4, and now the fifth of this move is to develop. And of course, I can't rule out there'll be further subdivisions of the fifth itself, because we haven't really achieved our longer term targets as yet. But no, this is the data that I get in Metastock, is actually the international data, and it's closed at 75.48, whereas the official close yesterday was 74.85. So that's all, like I said, it's 60 paisa higher. And the April futures are actually trading an entire rupee above that. So they closed at, so when this was 24, it closed at actually 75.24. And the next month now, with this spike up, probably it will only open, the April futures will open only at 76.5 or so if it maintains the same premium. So that's what you're seeing, a huge premium. I wonder if it will further expand. If I take another chart, and this one is of the USD INR futures. The reason I'm looking at futures is to show you the open interest. Now what you see here, this is the open interest, this is the volume. Okay, and the open interest here is the highest on record in the history of NSE. Now nobody's talking about this because people are too busy looking at Nifty, and they're really not looking at what is happening in the currency pair. And so at almost 42 lakh contracts was what, almost 48 lakhs at one point of time in the March series, and now after the rollover, it's around 42 lakh, 43 lakh contracts, I think, in the next one series. So it's still at the highest on record. So are the volumes. Volumes are now equal to what they used to be before Raghuram Rajan came in and, put a, completely backstopped all trading in the currency market, which is completely weird when you should be opening up the market and allowing more participation. Just to stop it from, getting weak, they stomped it, and what you saw was a huge drop in volumes. And it's taken almost 4 years before volumes actually picked up in 2019, and now you're actually seeing volumes come back again in the current move. So you have significant volumes back to previous highs and all-time high in open interest at this point of time, and very high premiums. Now some of this may appear like extreme sentiment, if you're seeing such high data points, probably it's at the end of the move, and I'm marking it as 5 of 1. But I do expect, looking at what is happening and which is why I've gone through this whole thing, starting with the dollar, what is happening on the dollar, more importantly, what is happening to emerging markets versus the dollar. So when the emerging market currency pairs are weakening and they have at least one more meaningful leg left, you don't want to stand in front of this. You don't know the size of 5. We can say it will be small, it will be big. So let it play out, because the pressure is very, very high. That much is clear. If the pressure was not so high, you wouldn't have had the US dump trillions of dollars worth of currency right into the market to keep it from going up. Now, of course, the DXY has been falling for a week, but you really want to see whether that fall continues. I mean, imagine after so many trillions, 4 trillions of Fed intervention, you really aren't seeing the dollar index collapse, which it would have under usual circumstances. And if it's falling so slowly, and gold itself should have exploded, so which means there's still some hidden dollar pressure, and you want to see whether that shows up in price action. It's definitely showing up in price action of the individual pairs. It's just the DXY itself, which is the developed market currency pairs, that are getting all lopsided because of the way central banks of the developed markets are acting. One on one side, I fire a bazooka, you fire a bazooka, and so the index, the cross pair, is really not reflecting the dollar pressure, which shows up more in other pairs. And so when it shows up in other pairs, the secondary effect I discussed in the last video is directly on bond markets, which is why bond yields across many countries actually spiked. Now they've cooled off a bit, including on ours, because we've lowered rates, and the bond yield, which I was saying, the risk is if it crosses 6.5%, it would be indicative of a big rise in rates coming. And the RBI stepped in and didn't allow that to happen, and yields have dropped back to 6.2% or lower. But I'll keep a watch out. Do yields really break lower, or they again turn around and go higher? Do we complete a 5-wave decline, or we don't? I think those are going to be important facts for the coming week. more important to understand the macro situation, apart from simply looking at the Nifty for levels. So this is the big picture I think I wanted to get out on the dollar. That's the most important factor that will tell us what equities are going to do, and the deflation trade which we are seeing in terms of weaker oil prices, weaker commodity prices are all linked to a rising dollar pressure. And so if the dollar is weakening so much, why don't all commodity prices go up? And oil was again down yesterday, so and copper was flat. You've really not seen big rebounds across that part, and you'd want those signals to accompany a weakening dollar if it's really a trend change that is happening. So last but not the least, the Nifty itself. Have we really made a meaningful bottom here? A couple of my followers have been saying, because moment it came close to 9,000, and I think I mentioned it in my podcast, 9,000 was a key level. And the reason it was key was it was 38% of the last sell-off prior to this ending pattern that we are now seeing on the daily chart. And so this part, if you take 38%, was around 9,000. So that was a key retracement. We have stopped there. We didn't close down for the day. And if we'd gone above that, I would have to actually consider whether the decline is complete and you're doing a larger retracement all the way to 10,000 or something, which was the alternate view. Now, I'm not able to confirm that. We are still below 9,000, and my sense is, my preferred view is that this bounce is most probably a fourth wave. The debate that analysts can have, and I'll leave it open for a later day, is where did wave 1 and 2 of this move complete? Did it complete here, or did it really complete here? And these are different arguments. My sense is that this fall here doesn't look like a 5-wave decline on the daily chart. I have to really go down the hourly chart and try and fit something. Now, if you have to fit something, then I don't really like that count. So I like the count of really marking it here. That makes more sense to me. And then what would you mark the topping out pattern here as? So it might be a triangle. I have seen this more recently in currency markets, and earlier I used to see it in currency markets. Now I see it increasingly in equity markets as well, that when you reach wave E of a larger structure, okay, which means that we are saying that this entire structure at the top for Nifty is an ending pattern. Okay, so if this is A, B, C, D, E, so wave E of it itself ends up developing sometimes a triangle. So what you end up doing is within E you end up getting an ending pattern. So it's possible that even this was an ending, and even after it forms that, sometimes you keep forming a triangle. So I'm wondering whether this itself, because this is a corrective structure, is A, B, C, D, E, is some kind of a contracting triangle here. Very, very unusual setups, but like I said, you've seen that happen in currency pairs. And as long as everything is 3, 3, 3, 3, 3, you're basically extending into an A, B, C, D, E structure. So you end up with a lower degree E, which then again becomes, in E itself becomes an A, B, C, D, and so on and so forth, till it really completes. This is something that I've seen happen. You may not find it in textbooks, but this is just my observation. So what we have here is an ending pattern. You usually would look for an ending pattern in the fifth wave of something. Probably this is the fifth of third. This is a fourth, and what I'm looking for is one final leg for wave 5 down. I think a lot of people would concur to this. They'd argue about the 1-2 part, but they may concur on at least this being 3 and 4 till we are below this level, and we are looking for lower levels. My daily levels and updates on this, of course, posted in the Nifty daily report that I write every day at Indiacharts Insider. So for that, you can simply subscribe to the Nifty daily report that I put out every day. So just go to Indiacharts.com for that. And this is the immediate outlook. And this is very similar to what we are probably seeing in many, many markets, including the US. If we look at the S&P overnight, and to make it simple, we simply look at the weekly chart. Okay, so what we are able to see on the weekly chart is a fourth wave bounce, and what should follow is a fifth wave. So the whole discussion becomes on the size of the fifth, nature of the fifth, and how do you really ride it, which is trail it, because fifth waves are extremely notorious. They can be truncated, they can be equality to wave 1, and they can be extended. And so the right way is to really learn to trail and ride it on a method and make the most of that move before we really look for another potential bounce. That's all in this update from me. Thank you.